Welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money-colored commentator. On today's show, the tax advantages of cash value life insurance, part 2 in our series on index universal life insurance, an emerging asset class, with nationally recognized retirement expert and certified financial planner, Chris Jacob. Welcome to the second segment, Chris.
Thanks, Steve. Great to be here.
Okay, first segment, we were talking about indexing and the history of it. Good history, by the way. And most people say the S&P 500 is the poor man's portfolio. It's a good place to start if you haven't started anywhere. That's a good place. Low management or zero management fees, and look at all the things we can do because of the life insurance equation on the tax. Talk a little bit about why this is so important.
Well, life insurance has afforded some unique tax advantages under the code that you're just not going to get with any other asset class. And for instance, FIFO, first in, first out, I can withdraw to basis. Gains, however, I can access, as you're going to see, tax-free via some policy loans. And there's been some new variations, generations that have come along in those loans that have made these things even more attractive. Because quite honest with you, up until 2012, I never considered these things as accumulation distribution vehicles. And we'll talk about what's changed in order to change my mind when it comes to that. Okay.
Also, so you have your recent convert.
I am.
Okay, fair enough. Well, okay, so let's talk about your the basic plan of why is it tax-free, just so that our people know why do we get this privilege?
It's basically because of the tax laws, and we'll talk about those tax laws, the history of them. But let's talk first. If I could design my ideal asset class, ground floor, what attributes would it have? Well, I'd love for it to grow tax deferred. It'd be better if it came out tax free. I want to get a good rate of return, unlimited contributions. Wouldn't it be sensational if that was deductible? Use it as collateral if I need or want to. Safe harbor from lawsuits, judgments. No loss provisions. If it's tied to the market, I don't want to lose anything. I don't have to qualify for a loan. It's guaranteed. I don't even have to pay the loans back. It's unstructured. I got what I call the luck factor, liquidity, use, and control. Normally that ends with a K. Hopefully I can impart some knowledge here. And maybe additional benefits, like it covers me for disability or long-term care. Okay, so where can people put their money? Savings money market account. Here's the attributes. What rate of return can you get on the savings or money market account? About the same as that certificate of disappointment, right? But even if we had the good old Jimmy Carter heydays of 18%, it would be taxed at ordinary income rates, right? Where else can you put it? Well, you can take a home equity line of credit. You got to put the home up for collateral. You could have a margin account in a stock portfolio. You could have a margin call. This is where most people are putting their money, and we're going to have a whole separate segment on this. Tax deferred, tax deductible. Permanent life insurance. If you structure this properly, which is critical, you are going to get 11 out of 12. You're going to hear a lot of negative press on this. We'll cover that in a separate section, but here's how we structure it critical. I tell people, when you see this lesson on life insurance, you'll know more than most insurance agents know or more than what they're willing to tell you. So this part of it's going to be 5 minutes. Promise to do it in less than 6. Just kidding, Steve. All right. There's a maximum amount you can purchase a life insurance policy for. There's a minimum. Who determines the minimum? This one's pretty easy. There's sharp guys with pocket protectors with pens coming out called actuaries. Say, based upon your age and amount of insurance, this is what we have to charge you in order to make a profit. Steve, did you know there is a maximum amount of money that you can put into a cash value life insurance policy?
I did not know there was, except for justification, I did not know there was a max.
Any idea who determines that other than you?
You probably thought it would be the insurance company.
One more guess. People usually get this right. The federal government. So let me ask you a question. If the federal government is remotely concerned how much you, me, anybody else funds into a cash value life insurance policy, what does it tell you about it? What would you say, Steve? What does it tell you about it?
It's a pretty good deal.
It's a good deal, and it's a good deal in relation to one thing. Otherwise, they wouldn't care. Taxes. So, a little history on me. I started back in '84, and back then we could do this, and we did this. We'd stuff $100,000 into a death benefit of $102,000. Withdraw to basis, no taxation. Gains, tax-free via policy loans. Worked out great until the insurance industry advertised life insurance as, quote, the last best tax shelter. And then we could talk about those wonderful tax reform acts that they came around and they said, yeah, it is too good a deal. In our world, it's known as MAC. That's the acronym, Modified Endowment Contract, where they put a governor, they drew a line in the sand that said, yeah, it is too good a deal because if people keep doing this, they're not going to do what we want to do with the money, which is to put it into those qualified plans so we can tax it later. So simply stated, if you overfund one of these life insurance policies based upon your age and amount of insurance, you die, it's paid out income tax-free as a death benefit. But if you want to access it during your lifetime, they're going to tax it just like withdrawals from those qualified plans. So if you wanted to get a $500,000 policy and you could obtain it for $1,000, or you could get it for 10 grand, being a good Costco shopper, which one are you going to do, Steve?
Yeah, I'm doing the cheap one.
Give me the maximum amount of insurance I can get for the least amount of dollar outlay. That's always been the thinking. Well, in order for the insurance company to get me to want to put 10 grand into a policy I could indeed get for $1,000, there better be some what? Benefits. And here they are. Let's make it a MEC. Let's make it a maximum efficient contract, not a government modified endowment contract. PLI stands for permanent life insurance. Structured in antithesis of insurance, give me the least amount of death benefit in relation to the amount that I'm funding. I'm going to get 11 out of 12. The only thing I'm not going to get is deductibility. So green's good, red's bad. On the left side are all the things I would like in my asset class. Going across the top, permanent life insurance, HELOC, margin CD, money market, 401k. Steve, where would you like to be putting your money?
I like the green.
Where is everybody putting their money?
Yeah.
In the 401k, right? So what if you could capture up to 11 of the up markets only, some are higher. You could lock in those gains guaranteed by some of the biggest insurance companies in the world. Here's the tax codes. It all grew tax deferred. Distributions came out tax free, and you had ready access to that cash. When I ask people that, if you could have all of that, what percent of your low to moderate risk portfolio and or your annual savings would you allocate to such an asset class? Mm-hmm. Guess what most people over 50 tell me?
All of it.
Every single time.
Right.
Now, we're not going to let them do that from a fiduciary standpoint. It's not the right thing to do. So typically it's capped at 11. When the market's down, 0 is your hero. You don't lose any principal or gains. Would you rather compound or rebound at this stage of the game? So like when we had practically as much carnage in 2002 to 2008, can you imagine how much better you would feel if you didn't lose any of your principal or any of your gains? That's why we say this should be an important part. Now, it's not a panacea, but an important part of an overall plan. So in 2014, Guinness Book of World Record wasn't for the tallest man, longest fingernails, went largely unnoticed. Mystery billionaire buys record-breaking $201 million life insurance policy. Why would a billionaire buy life insurance? Won't his kids be okay if he dies prematurely? Or was the media missing the point? Now, do you think that billionaire went to his advisors and said, is this a good idea or not? Of course he did. So 22% of this asset class is owned by the wealthiest 1%. 55% is owned by the wealthiest 10%. As a matter of fact, let's look at Wells Fargo Bank. This is their balance sheet. Notice $8 billion in bank premises, other real estate, $5.2 billion. Life insurance cash value, $19.2 billion. If you didn't know better, you would say they were an insurance company. How about our good friends over at Bank of America? $11 billion in bank premises, fixed assets, other real estate, $3.2 billion. $18.4 billion in cash value life insurance. What do they know that the rest of us don't know? Well, remember I said something happened in 2012? It's called this. It is a participating loan. Simply stated, I can make money as I borrow money. I know this sounds like voodoo economics. However, I've got cash in the policy. I borrow, my cash continues to grow. Where else does it work like that in our world? If I have a home, it's completely paid for, and rates go up in my neighborhood by 10%, it goes from 200 to 220. If I got a home, it's $100,000 loan against it that I took out from the bank. And Steve, let's say it's a 4% loan. You still get to live in a house that can still go up in value. A year later, the bank says, Steve, you are such a great referral source. We're going to credit you 6% on the loan. When would you want to go pay back the loan? They're going to charge you 4 and credit you 6.
I'm not going to pay it back.
Favorite word in the English language, arbitrage. Mm-hmm. So that's what happens with some of these newer policies. You're borrowing not from the cash value, but against, in which case my cash, the loan, just gets paid back when I die. That's how I can actually make money as I borrow money. By the way, if you're interested, you can go and there's a deep dive of about 13 videos that go into the strategies that we're talking about in indexed universal life.
So let's just review, just make sure just to summarize before we leave the segment. I can withdraw at a basis tax-free.
Correct.
I can take policy loans tax-free as long as I keep the contract in force for the life of the policy insured.
And that you don't put too much money into it, that you don't go over that cap.
And I have to obey the TAMRA compliant rules, so I'm not overfunding so much so that it's not even insurance any longer.
Correct.
All right. But you just brought up another one. I could even select arbitrage loans, which if my index is performing, I would actually make money on my own personal loan. That's what I thought I heard you just say.
If my loan rate to borrow from the insurance company is fixed, guaranteed for the life of the policy, for instance, at 5%, and I got a 0 floor and 11 cap, the worst I can do is accrue interest at 5%, but in a good year, I can actually make money on borrowed money.
On borrowed money.
Yes.
Yeah, see, and it's your money. It's like you're being the bank yourself.
Didn't happen until 2012.
That's a recent event. It's a recent event. Listen, don't forget to watch our next segment, Indexing in a Universal Life Policy, Part 3 in our series on Index Universal Life Insurance as an emerging asset class. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.